Hello, we are Group 5. Today we are going to talk about our target company ASUS and comparable company Asus. And this is our group member. We have Smile, Rita, Brenda, and Wendy. And this is our table of contents. The first part is company introduction, and then dividend discount model and flow to equity model, then free cash flow model and adjusted present value model, and residual income model and multiplier approach, and our investment suggestions. The first part is company introduction, and for ASUS, it's our target company, and it is its major business is design, development, and sales of 3C information product. It is a multinational company known for the world's best motherboard, PCs, monitor, graphics card, and routers. And ASUS lead the industry through cutting-edge design and innovations made to create the most intelligent and joyful smart life for everyone. And for our comparable company Acer principal activity are to develop, market, and sell computer workstation, PC service, business desktop, computer-related component and software. And other activity include repair service of Acer brand products, investing, financing, construction, and provision of internet, electronic service, and information storage. And in addition to being an OEM of various types of computer, Acer produce service, storage system, projectors, and displays. The company also provides IT support service.
Next, I would like to talk about the financial statement and ratio analysis. In conclusion, the profit of ASUS and Acer increased sharply after the COVID-19. Higher profit is because of higher sales or revenues. One of the reasons that increased revenue is the trend. The COVID-19 made the trends change. Computers and smartphones are very important for people in this generation. So the demand to buy computers, smartphones, and other devices increased more and more. Overall, ASUS is more effective than Acer. It can generate higher sales and profit, and also can control expense well. This is because ASUS prioritizes investment in research and development. It spent more than 16 billion and 20 million in 2020 and 2021 to produce innovative products. For example, we can scan face instead of using password. We can light on the computers by using pen, something like this. Although the research and development affects reducing in operating income in the short term, ASUS will gain more profit in the long term.
The second part is about dividend discount model and flow to equity model. And we will calculate ASUS first. We search for the dividend paid by the ASUS from 2015 to 2021, and we calculate each year's growth rate, and then we turn out to the 11.63% of 6 years, and the capital compounding average growth rate is calculated by the stock price of 2020, end of the 2020 and end of the 2015. And the cost of equity is the dividend of 2021 divided by the stock price of end of 2020 and plus the growth rate of dividend. And then the number is 28.4%. And the growth rate, you can see it is the price and multiply to the cost of equity and then minus the dividend of 2020 and then divided by the price of 2020 plus dividend of 2020 and the dividend of 2020 is 26 and then we calculate the dividend of 2022 as 25.16 and the and we calculate the quantity as we use the dividend of 2022 and then divided by cost of equity minus cost CAGR and then it's turned out to be $83.78 and then go to the answers. The method is the same and we calculate that the growth rate of dividend is 24.57% and the compounding average growth rate is 14.34%. And the stock price of the end of the 2015 is 12.1 and of the 2020 it's 23.65. And the cost of equity we calculate is 34.21% and the growth rate is just 26.21% and dividend of 2022 is 1.5 and we expected that the dividend of 2022 is 1.96 and we calculate that the quantity is $9.87 per share.
Next, I would like to talk about 4-to equity model. Let's start from ASUS. This table will show you about the present value, common equity, and outstanding shares in 2021. After calculating, the value per share of ASUS is about 974. This slide shows you about 4-to equity model of Acer. We use the calculation of 4-to equity, same as ASUS. The value per share is calculated based on the common equity and outstanding shares. After calculating, the value per share of ASUS is about 87.
Next, we will introduce the free cash flow model. And first is asset economic balance sheet. After listing the core operation items and the non-operating items, we can get the result of core operation items plus non-operating items. And next is asset items in debt, OCIP, and common equity. And then we can conclude that the result of the sum of the three items is the same as the sum of the core operation items and the non-operating items. About assets economic balance sheet, we also listed the core operation items and the non-operating items, and we can get the sum of them. After listing assets items in debt, OCIP, and common equity, we can get the sum of them is equal to the sum of the core operation items and the non-operating items.
Hello everyone, I'm going to introduce the cash flow adjustment. The first step in free cash flow valuation is to develop a historical free cash flow statement. We can calculate appropriate historical ratios directly from GAAP financial statements because these ratios would include the effects of transactions that are not related to core operations. So we have to remove the joint ventures, interest expenses, other income, other gains and losses from the free cash flow. We will add them back in the non-operating cash flow and capital cash flow to make the net cash flow in the two statements equal. It is the same in the cash flow adjustment for Acer. After the adjustment, we use the historical relationship to set the forecast assumptions. The upper table shows the process of obtaining the fair value of minority interests, and the lower table shows how we calculate the weighted average cost of capital. The most important assumption is that the expected market risk premium is 10% because the market risk premium in the US is approximately 8%, and there is a 2% risk premium for Taiwan's country risk, and we derive the cost of debt regarding Acer's International Credit Rating (BBB). So, we discount the forecasted free cash flow with weighted average cost of capital, obtaining the present value of free cash flows, adding back the non-operating assets, debt, other capital claims from the economic balance sheet, minus the majority interest, and then obtain the value of common equity and value per share of ASUS, which is $565. Acer's valuation is in the same way. Finally, we obtain the value per share of Acer, that is $37. This is the combined sensitivity test. In this part, we use the change in revenues and the change in operating margin percentage as the variables to test the sensitivity of share value to the differences in assumptions.
The next valuation model is FPV model. And at first, we calculate the unlevered beta and then use it to get the unlevered cost of equity. We can see that Acer's unlevered cost of equity is 6.35%. With all the relevant information we need, we discount the free cash flow with the unlevered cost of equity, adding the non-operation, debt, and OCAP from the economic balance sheet. And then we minus the fair value of minority interest and add back the value of leverage to get the value of common equity. In the end, we can get assets to be worth about $336.19 per share dollars. And about Acer's FPV model, also we calculate the unlevered beta and we can get its unlevered cost of equity is 6.32%. With all the relevant information we needed, we discount the free cash flows with the unlevered cost of equity, adding the non-operation, debt, and OCAP from the economic balance sheet. And then we minus the fair value of minority interest and add back the value of leverage to get the value of common equity and value per share. And after comparing the result of the free cash flow model and the adjusted present value model, we can see that Acer's share prices has a significant differences between the two models. And the stock price calculated by the adjusted present value model is closer to actual share price. However, Acer's share price are very similar in the two different models.
This part we are going to talk about the residual income model. And first we are going to talk about ASUS. And you can see the slide is divided to two parts. One is the history data of 2021 and the next part is the forecasting data of 2022 to 2027. It's about 6 years. And we assume that for the forecast data, we assume that ASUS high growth rate will slow down by 2% in the following years. And then we have calculated the free cash flow of each years. And then after calculating the free cash flow, we calculate the book value of the core operations. And you have to notice that the ending balance of these years will be the following year's beginning balance. So if the number are different, that might be some mistake in your calculation. You have to check it. And after calculating, we know that we get the number of value per shares of 2021. It's about $482.94 per shares. And we want to calculate it to 2022. So we multiply by 1 plus cost of equity and then turn out to get the number of $527.24 per shares.
Next, I would like to talk about residual income model of Acer. This slide shows you about the free cash flow calculation of Acer. It will be separated into two parts. The first one is historical data. Another one is forecast data. For the forecast data, we assume that the Acer's high growth rate will be slowed down by 2% in the following years. We also calculate free cash flow for the year 2021 and for the 6 following years. Total is 7 years, and free cash flow is shown in the table. This slide shows you about the residual income model of Acer. After we calculating free cash flow, we will calculate book value of core operation. Please be careful that the ending balance of the current year will be beginning balance of the following years. After calculating, we get the value per share of the current year and the next year. Value per share is about 57 in 2021 and 64 in 2022. Please be careful that the value per share of the next year will be calculated by cost of equity.
This part we are going to talk about multiply approach. And the first one is PE ratio method, and we use the Acer's data to calculate for the stock price of ASUS. And the growth rate we calculate the following years is the last year's multiplied by 0.7, and the perpetual growth rate is 2%. And the PE ratio equal to the market value per shares divided by EPS. And so the price is equal to PE ratios multiply EPS. So we calculate the price of ASUS. It will equal to PE ratio of Acer's multiply EPS of ASUS, and the number we getting will be $951.12. And for Acer's, the growth rate of the following years equal to the last year's number multiply 0.6, and the growth rate is also be 2%. So to calculate the Acer's price, we use the PE ratio of ASUS multiply EPS of Acer's, and we got the number of $73.16. And going to the PE ratio, and use the data we calculate in the last slide, and for PEG it will equal to PE ratio divided by the growth rate, and the price of ASUS we use PEG of Acer's, it will be 680.98, then multiply by the growth rate is 2%, and multiply the EPS of ASUS, it will be 69.84. So the stock price is about 951. And for the price of Acer's, we use PEG of ASUS, it will be 782.66, and multiply the growth rate of 2% and multiply the EPS of Acer's, it will be 4.615, and the share price was got is 73.16.
Next, I would like to talk about PEU ratio method. For the PEU ratio method, we will calculate the value of the common equity in each firm, then divided by shares outstanding to get the future share price values. The basic concept of this method is to exclude the difference of the firm's capital structure. In other words, for a non-borrowing situation in each company, their PE performance will be the same. For the first step, we will calculate the PE of ASUS and Acer in order to calculate common equity value further. Then, using common equity value divided by share outstanding to get the future share price values. After calculating, the share price of ASUS is more than 3,000, while the share price of Acer is negative because diluted earnings per share is negative in 2016. Next, I would like to talk about MBL ratio. For the MBL ratio method, we will calculate the value of the common equity in each firm, then divided by shares outstanding to get the future share price values. Compared to the method above, the MBL method calculated the value to book ratio. First, for the purpose of calculating common equity values, after calculating, the share price of the ASUS is about 27, but the share price of the ASUS is about 164. It means that the share price of ASUS is underrated, but the share price of Acer is overrated. We assume that the reason resulting in this unreasonable outcome is the budget difference between the book value of equity between ASUS and Acer. Next, I would like to talk about MBU ratio. For the MBU ratio method, we will calculate the value of the common equity in each firm, then divided by shares outstanding to get the future share price values. For the first step, we will calculate the market to book ratio first in order to calculate common equity values. Then, using common equity value divided by share outstanding to get the future share price values. After calculating, the share price of ASUS is about 384 and the share price of Acer is about 17. So, the share price of ASUS is overrated and the share price of Acer is underrated. Similarly, this is because of the huge difference between the book value of equity between ASUS and Acer.
And finally, it is the part of our investment suggestions. In Acer's case, we would like to make recommendations using the FPV model. The FPV model uses different discount rates to discount different types of cash flows, which effectively avoids the large error that may be caused by the WACC of different natures. In addition, it has greater compatibility and plasticity in general, so it is more suitable for Acer's case. And the graph shows the daily stock price of Acer from 2018 to now. From the method of FPV model, we calculated the target price of Acer to be $336.19, which the current share price of Acer is $342.5. To sum up, our recommendation for Acer is not to buy, as data suggests it is overvalued. So, in our opinion, it's better to stay on the sidelines.
Next, we want to make a recommendation using the free cash flow model. Free cash flow model is the most persuasive valuation method for investors because it represents the company's core operation the best, and the profitability in the future is recognized by the market the most. The graph shows the weekly stock price of Acer from 2006 to 2022. The record high is nearly $75, and the record low is lower than $10 per share. According to our free cash flow valuation and sensitivity test, the stock price should be between $10.4 and $72, which are very similar to the historical data. If we narrow the range down, it will be between $23 and $54. It seems a little bit higher than the stock price in recent years. The graph shows the daily stock price of Acer from 2018 to 2022. Our target price, $37.66, which is obtained from the free cash flow model, is higher than the current stock price of $29 and is near to the 8-year highs in June 2021. In conclusion, we recommend that Acer stock should be bought in because it is undervalued and still should have 29% ascendant spaces. This is our presentation. Thank you for listening.